This was a challenging module as we really started to cover some tax law. We left behind the world of income and deductions to talk about what is commonly known as property. Here's your Module 3 summary. As usual for our summary videos, here are our Module 3 learning objectives. And as is typical, we'll go through these one by one, at least briefly. So recall deduct versus capitalized. Capitalized means going to spend some time on the balance sheet. And it does that if it substantially increases the value, increases the useful life, or adapts the property to a new or different use. And deduct means it just goes straight to expense. And of course, deduct is generally preferred. And repairs and maintenance, for example, can be deducted as opposed to capitalized. So capitalization versus cash flow. Recall that when we capitalize something, we basically debit the asset and credit to cash. And then what happens is its subsequent cost recovery is a non-cash item. And of course, that's one of the reasons that deduct is preferred, is because we get to deduct that cost immediately and lower our taxes. So cost recovery from any long-lived assets, the answer is, of course, depreciation. It could be amortization for intangibles, and for natural resources, it's depletion, and we didn't cover that. And recall that basis is a magic term. And basis can also be recovered through a sale, exchange, or a disposition. So, for example, the sale of equipment results in a realized and probably recognized gain or loss, versus the sale of inventory results in ordinary income and is offset by the cost of the goods sold. So continuing with cost recovery, depreciation is this prescribed system. The one that's currently in place is called makers. We determine conventions and then apply tables. And we know there are special depreciation provisions like Section 179 and bonus that really accelerate those deductions. And then amortization was mostly for intangibles, and it's pretty much straight line, and in most instances it's over 15 years, but there were a few where it was over the useful life. So sale exchanges and dispositions, if there's one thing we should know, it's that when you have a sale exchange or a disposition, the amount realized minus the adjusted basis is the realized gain or loss.
Learn it, know it, live it.
So most realized gains and losses are recognized. We learned about installment sales and related party losses, which prevent that from happening. And we also know that the gain that we calculate is not equal to the cash flow. That's the pre-tax cash flows minus taxes. And for when it came to character, we learned what was not capital. And we went through Section 1231 for trade or business property held for more than a year. We talked about how if that results in a net gain during the year, it's a capital gain. If it results in a net loss in the year, it's an ordinary loss. But that we have this look-back rule we have to apply when we generate 1231 gains. We also unpacked depreciation recapture. And we looked at Section 1245, which was personal property, and that's often called full recapture. We looked at Section 1250, which was on real property, and we only recaptured accelerated. They call that partial recapture, but then we discovered this new word in our lexicon called unrecaptured, and we use that to determine what to do on the sale of 1250 property by either an individual, which was we treated as a 25% 1231 gain, or a corporation, where we take 20% of it under Section 291 and treat it as ordinary. All right, that is the end of Module 3. I can't believe we're through 3 modules of this. You guys are doing great.